friends, welcome to Nirmal Bang. Today we are bringing to you the conversation with market expert. Now, markets are right now of importance to us. January has passed. We talked about February. Have also passed as an event. And last year was a tumultuous year where we saw a lot of global events. But now the real question here is that the FI money, which seems to have been returning, is it looking like a durable sort of return? Or what the sort of selling we have seen in some pockets of the market that perhaps could be sort of leading to some sort of return of selling? So I think that is one question. Second question is perhaps this year, if it is looking different from last year, which are the sectors actually which we really should be looking at, and what are institutions really thinking about? And for discussing all of that, let me today welcome our guest, Mr. Devalkar, Senior Fund Manager, Equity of Axis Mutual Fund. Shreyash, welcome to the show. Now, for our viewers, I think the Shreyash doesn't need any introduction because he has been a veteran in the markets, has been managing many funds, and a couple of funds basically also actually are my favorite also. Have been star performers if you actually look at the last 3-5 year categories. So let's first actually start question straight away. And there's sort of I was looking at your funds, and one actually fund stood out was Axis Medcap Fund. And my question is not on the fund perspective, but I'm largely actually going from the perspective of thought process here. So when I was looking at the Medcap Fund, there were a couple of winners there, like Cholamandalam Finance 4 times in the last 3 years. ICICI Bank, we all know what happened since the management change. It has been a great turnaround story and almost a favorite for many institutions now. Indian Hotels, again, since the time they went to sort of asset-light model, great success story. Supreme Industries, Astral Poly. There are so many stocks, again, which are winners, outright winners in your portfolio. I want to touch upon the thought process where when you see such multi-bagger returns, after that, what happens? What actually you think? Is it a time to book profits or you're very happy in their performance? You keep on holding them. How you actually think around that?
Yeah, thanks for that question, because that always has been a trick that whether you should look at the valuations or what is supreme or the long-term business model. Here, especially in mid and small cap categories and mid cap categories, it is all the more important to buy and hold on to the winners, and especially if they are going to deliver over the longer period of time, because churning or changing because of the valuation is easier said than done. And in case of smaller companies, the entry exit costs are also relatively higher. So in that sense, one need to have that long-term mindset to marry it with what are the anchors you are looking forward, because valuation is one anchor definitely which one should not forget. But apart from that, normally in a market, we call it as an equilibrium market. Market always provides you equilibrium, wherein everything looks like that it is the valuations are fair, or valuations are pricing in everything. So during such scenario, which is normal scenario, you have to go back to the basics, which is the business. What is the right to win for that company? Because of what particular specific things and mode of that company or industry structure, because of what you are holding that. So what is the right to win, and whether it is changing or not. If it is changing for worse, then obviously that is the trigger point rather than valuation. And that's where the right to win, whether it is continuing, whether someone else is coming out with better product, or there are multiple players which are entering and just spoiling the market structure. So all those things, which is the right to win, that is important. Second aspect is room to win. And a room is more dependent on which category you are. And again, since we're talking about the mid cap fund, normally you will find that in the large cap fund, the room is lesser, because there in the large cap companies, the companies are those sectors are big, but the companies are also big. So there your tendency of growth of a company link and very it being linked to the GDP growth is very high. While in case of mid cap and small cap, where the penetration is low, that tendency may be low. Again, in case of export-led companies, especially in those cases, the tendency to get linked to the local GDP may be less, and because though global GDP growth rates are lower, but then again, their room to win is very high because you can export to multiple countries. If you are successful, you can gain market share. So these are the angles where right to win, room to win, whether it is improving or deteriorating, these are the primary focus or the anchor for taking a decision to buy or and hold rather than just a valuation.
Right, and I'm tempted to ask you one question here. Now, let's assume you found out a multi-bagger, and I'm taking examples of stocks to make viewers understand, and I fully understand that you will actually be talking about sector because of compliance reasons. But for example, like you spotted Cholamandalam Finance, a very strong multi-bagger, very heavy weightage in your fund. There was also Bajaj Finance. Cholamandalam Finance did well. The reasons could be management quality, opportunity, valuation, anything. After a particular time when the stock became 4 times, there must be a time coming when you will start seeing, okay, this is also an NBFC, this is also an NBFC. Management quality might be a sort of criteria. So at that time, basically, what happens? Like you are actually sort of, if the management quality is same, then what's the thought process of a fund manager like you?
Sure. So that's where again going back to the same. So since the management quality is same, whichever companies or sectors you choose, in that case, it goes back to the right and room, and especially if we talk about the sector, which is the financial services sector, you will observe that there are more companies or a longer term. Actually, the larger companies and larger banks and NBFCs has been winner over a longer period of time,
Yes.
rather than someone coming from the bottom and then a small cap becoming large and large, mid and mid becoming large. There are fewer cases of that compared to the large getting larger. If you take this, do the historical analysis, and one need to understand why that would have happened, because end of the day, the product is so to say commoditized. So housing loan is a housing loan. Whoever gives as a consumer for it doesn't matter as long as the rates are low. So in that situation, so what niche any particular bank or NBFC has created, and without compromising too much on the asset quality, because it is always any country would be credit hungry, right? So, but the point is whether you're doing it right, collecting it back, and with a high ROE and good ROE, and that doing it repeatedly over cycles. These actually so the cycles, if you take the COVID as a cycle, or before that maybe the IL&FS led crisis, or before that maybe demon or twin deficit, even the corporate credit cycle has been bad during 2012 13 till 2018 19. So during such times, who have done it well repeatedly, crisis after crisis, those are the very important factors which actually are critical to assess long-term sustainability of any team when it comes to bank and NBFCs.
Right. So that's one point about what again basically fund managers, what you would be thinking around the winners here. Now let's go to the big picture. We have seen how the last year has been, whether we call Russia-Ukraine war or interest rate hikes. This year, calendar year 2023, how is it looking to you? We have seen the budget also, where the money is going to go into. So when we take a look at the bigger picture, which sectors you are really liking now for this year, and how's the overall market looking to you?
Sure. As far as the sectoral, probably we'll start with the individual segments which you highlight, or with individual developments. So one is budget. Again, I would say that budget as such on its own generally don't matter too much to the market. Broadly, the policy actions which are being taken over last 5-10 years repeatedly, and those are actually has been very strong, and that has been really supportive to the growth for the economy. So those are the bigger picture. That is a bigger picture here as far as the domestic economy is concerned, rather than the individual budget, because nowadays most of the post GST especially, there is the decisions that would affect companies directly
Absolutely.
are maybe off budget more, and that's where that as a event don't have so too much impact unless there is change in the direct tax during the budget. Apart from that, the global events which you highlighted, especially the war, definitely the Ukraine war, it being probably getting restricted at a smaller scale, it may have some issues, or it has affected certain supply chains, and that's where there is inflation in some of the commodities. But the broader point here is whether we have to live with the relatively uncertain geopolitical world, and that's where the bigger question is now in such a scenario, or in this aspect. It's very difficult to predict, and more importantly time, that yes, something will happen this year, it can happen this year, next year, 5 year, or next month, you don't know actually. So there's no predictability around it, and you can't really plan around it. But yes, the fact of the matter is world is moving towards a more collaboration to probably more bilateral talks. So those things are definitely happening, and especially some of those developments, one need to be very careful. Again, when we talk about 2023, whether something happens, it's very difficult to predict. But then that definitely has to be at the back of mind when you are taking any decisions around export stories or commodities or any such stories as such. Apart from that, now coming back to the sectors and as such, the point is when the market is runaway market for long period of time, and especially sharp up move, which when it happens, generally it don't leave much room in terms of the relative valuations or relative sector calls. So beyond such point, generally the market becomes more leaning towards the bottom up stock picking across segments. One factor which definitely has affected is the when you take the economy, it is economy is about what consumption, investment, and net exports. Consumption recovery over a longer period of time. When I say longer, it is from pre-COVID till now, has not shown a widespread recovery as such. So probably if you take FMCG volume growth, not exciting. Two-wheeler or less than 10 lakh cars sales, maybe not exciting. Uh, on the other hand, top 10 city real estate growth, yes, very good. Then if you take again the vehicles which are expensive, probably 10 15 lakh plus, again the growth is expensive, and there is a definitely element of actually the booking periods are going up there, or the waiting periods are going up there. Now the point is that the K-shaped recovery is getting reflected in multiple sectors, so there is no homogeneous recovery in the consumption sector. So in that context, one need to be careful on the choices. It can be retail, it can be FMCG. The choices are very important. On the other hand, on the B2B side, that is in the B2B there are multiple such sector segments which are in industrials, or in case of other segments like chemical or auto ancillary, IT especially. Now here one need to take individual calls again, because with the sharp rally, the valuation differentials are not there much, and that's where there is very little room for error. So such a market generally is more a stock pickers market rather than a widespread sectoral call per se.
Let's build on the IT sector here. We actually have seen that there has been a large currency depreciation in the last 6 months. But now the interesting part for 2023 calendar year is that the bond curve and a lot of sort of US market guys, they're actually expecting a sort of softening in the dollar in the second half of this year. From that perspective, and also while some slowdown could be coming, IT becomes a very sort of tricky sector here. What is your opinion on IT sector? And I've also observed that there has been some IT preference also in your funds. Large caps, again, we have the sort of traditional favorites in FI and TCS. Mid cap, we have a very specialized names like L&T Mindtree, Persistent, all those. So my question is two parts. One, your view on the IT sector broadly, and second, within IT sector, is there anything particular you're looking for right now?
When it comes to IT sector, actually, I always have a so to say bias towards export sector because there the companies and the businesses actually have proven themselves that either they are cost competitive worldwide, they can deliver at scale, and after that there are also some of the important parameters like what is the right to grow even beyond borders, and you are globally competitive. You are competing versus multiple countries and economies. So in that context, it becomes very important to note that IT as a sector has come out very well, apart from any other exporting sector. Now, just linking it to the currency, it probably is not giving justice to the strength of the sector, maybe, because again, the currency has been depreciating, right, for last 20 years, from 45 to 55, 65, 75, 85. So if you look at the margin profile, whether it has dramatically changed for the sector, no, it's there in that teens, high teens, or slightly above that. So the currency per se has not impacted the profitability of the sector over a longer period of time because it gets passed on. And in most of the sector that happens because that is your country's strength, which you are playing on a relative basis again. Now that's where I would not like to look at the sector from the currency, especially point of view. Just an example, just in the last year, actually last year the currency depreciated, but the sector would not have given you returns, right? And that's the point. So and that's where one of the point you highlighted is the slowdown, and then what is the view around that. So point is that yes, it is a long-term trend. It will grow the way it has grown over a longer period of time. There is no point in getting excited over the spurts of growth, like in any other sector in IT as well. That there is nothing like inflection point and changing the growth trajectory. So one need to be very objective about all these things. And considering all those, yes, it remains a good sector over a longer period of time. Like many other sectors, this sector has also got its valuation elevated from pre-COVID to post-COVID basis on a pre-COVID to post-COVID basis. So in that context,
Are you actually forcing any sort of same consistent earnings trajectory, or you are actually looking at any sort of change, any sort of for this year?
the earning growth trajectory, which is the long-term growth trajectory, that has been the case for this sector over longer term. So there has been spurts in last decade or two at multiple point in time that it shows that yes, now it is some inflection point, but then the longer term growth rates are has been in that high single digit to low teens as such in last decade or so. So there is so one should go with those kind of expectations rather than expecting something dramatic happening.
Okay, so you again remain, like, I'm again asking a short question here. You remain positive on the IT sector for this year?
So, like multiple sectors, yes, we are positive on this sector as well, which is exporting sector.
Right, and I'm now moving into a very interesting sector. My observation had been that you really like the healthcare space, especially the hospital space. A very granular observation, whether large cap hospitals, mid cap hospitals, the hospitals which have just sort of got listed, even the hospitals which have a lot of listing history. A couple of names. This implies that maybe geographically, or maybe pan India, maybe the policy, or maybe the opportunity, there's something which you're really liking on this sector. Help us understand why you like the hospital sector.
Sure. This sector, again, one need to really dissect more into it. It's some of these companies have shown that year after year, because you already observed that there are some of them which are listed for longer period of time. Some of them are recent listing. Probably those companies have been there for longer time, though the listing has been recent. Now, in this context. When we look at this sector, there has been long-term growth drivers for this sector which are already in play and which has been in play. It includes the need for quality infrastructure. It includes government focus. It includes increase in the insurance penetration, especially the health insurance penetration. So there are, and obviously the population and as well as the aging population. So all these things, as well as the lifestyle diseases. So there are multiple, and more important factor actually is also the medical tourism. So there are these multiple factors which has been in favor of this sector for. It's not that now the recent phenomena. In some of these sector where there is organized, unorganized, there are multiple segments which are there. There is government sector also, there is municipal sectors also. In such sectors, some of these long-term theme, they play out over a longer period of time. Always you will find some ups and downs during this long-term journey. But then probably you would have observed that in recent past, if we go by the results of these companies, some of these factors have played out well. So again, as I said, these trends have been long term. There have been hiccups in it, and multiple period of time. Actually, this sector also got derated earlier. So one need to look at it more from the longer term point of view, rather than whether what is happening in last 6 months and trying to extrapolate it.
I want to ask one sort of a follow-up question here. My observation has been that hardly any bets on hospital stocks which actually are recovering or which are not doing well over the last 2 years. Your bet is very consistent, very visible. Any hospital stock which is generating 20% plus ROC or very strong double-digit ROC, that is where the money is going in. So is it something which is very sort of high importance to you that the returns on capital should be very strong?
Yeah, so when it comes to financial metrics, these are all the very important parameter. One is the return on capital employed or return on equity, and especially if you're talking about hospital as a sector where the capital employed angle is higher. So obviously, return on capital employed is important parameter, because here the growth beyond the point is because of the growth in number of hospitals or beds. So the capex is required, and we generally prefer businesses where the internal accrual can sustain the reasonable growth. See, if you want to grow much faster and if you have capability, then probably raising funds is definitely one should look at. But then considering the capability of the sector to grow, because you can't double your beds in 2 years or 3 years, right? So it has its own pace as such. So if the return on the capital employed, and more importantly cash flow generation is sufficient to continue this mid-teen or early teen growth, then that is what one should look forward to. If the company is growing faster, then obviously the internal accruals may not be sufficient. So all these angles become very important, and that's where more and more importance is definitely given to the free cash flow, operating cash flow generation, and free cash flow generation as well, in the case the companies are not growing the way they are. Do you want?
Sure. For our viewers, again, basically, the Axis Fund actually has Apollo Hospitals, Krishna Medical Institute, Narayana Hrudayalaya, Fortis, Rainbow Children Medicare, and others also. So these are a couple of stocks again which are there in the funds. So sort of have a look at them. From a perspective of real estate, hospital also is a sort of building up construction sector. Real estate you highlighted, there has been some strong growth, and we have seen some pockets of strong growth. Building material is one space where actually you need, if this growth is happening, then building material has to show volume growth here. Um, I've observed that piping is something where actually you have liked, you hold positions. Um, what is your view on the entire piping sector? we have seen again it is exposed to global commodity prices. PVC prices have slightly rebounded now. They actually were volatile a couple of months back. What is the overall sort of view on the piping sector, and how is it looking to you?
Sure. Actually, I would like to expand this to the building material segment as well, because that is very interesting part, and probably piping may be only one element of. There are multiple elements of this building material, and the way why this sector always excites a mid cap fund manager or a small cap fund manager is because again what I talked about, the right to grow and room to grow. Here the sector is big individually, while the room to grow apart from the normal GDP growth. See, if your growth, again, I'm just repeating what I said earlier, that if the growth is linked purely to the GDP growth, then you are the returns from your company is totally at the mercy of macro, while you want something to be beyond it. And in this sector, generally offers that more because of the possibility of shift from unorganized to organized.
Organize.
And this part is definitely prevalent in most sub segments of building material sector. It's not restricted only to the piping. In that context, there are multiple reasons why again this process, unorganized to organized, has been there in multiple segments, but the pace is different in different sub segments. So, and one need to get into the reasons why that pace is different. In some of the cases, it is as simple as whether there are managements who are just focusing on their business and trying to do probably repeated mundane work year after year without getting into too much of risk. So there are multiple such aspects one need to look at because this sector is provides you a lot of opportunity to play this theme. Over and above that, if there is a real estate cycle or so, then all the more it can add to the growth. But again, as I said that as an investor, the lesser you are dependent on cycles, the better, because it becomes very difficult to time and catch the up and enter and exit at the very right time.
Right. And I also want to sort of borrow your mind on the chemical stocks. From a size perspective, chemical versus building material, the size is very different. But I know you have actually your bets on specialized chemical where the margins are slightly higher, ROCs are much higher. How do you see the chemical stocks in 2023 after a sort of strange 2022?
So again, in chemical sector, same thing goes back what I talked about IT. So some of these chemical companies, it may not be something you are producing which is a unique molecule. It's not that. The point is whether you are globally competitive, because the exports for me, whether it is a chemical, IT, or auto ancillary manufacturing, if the companies are able to export, then actually it shows the strength in the cost competitiveness, that too globally, and that is where the real differentiation comes from. Apart from that, definitely various companies are trying to focus on multiple specialty. Actually, the beauty of this sector is most of the entrepreneurs in this sector actually are second generation. So this sector has been there in India for multiple years, right? And that's where the ecosystem of knowledge base has been there. Actually, one of the reasons why pharma sector also gained, and in some cases API, is because of our abilities and capabilities in the chemical sector as such. So that is now when the star gets aligned, it may be because of China plus one, because of whatever such reasons. Then if you are prepared, then it's always said that the one who is prepared always wins. So this sector is prepared and it is ripe for taking any opportunity which the market throws. Again, having rallied a lot for last 2 3, actually the rally in the chemical sector started around 6 7 years ago. It's not the recent phenomena. It has been getting re-rated from almost single digit P to 30 40 PEP, right? So that discovery has happened definitely. So one need to be very, again, as I said, that one need to be very specific in their choices now.
Right. And any particular view on the sector from earnings growth or any particular sort of specialty segment and any granularity if you want to share?
So yeah, in specialty, one need to definitely again in this sector it becomes very difficult to segregate what is the pricing rate growth, what is the volume rate growth, and in that context, that's where that long term aspects which you generally tend to focus on is when it is about specialty, whether you are among the few, what is the market share globally. So those things actually would be more helpful, and always it is observed that specialty has those kind of characteristic which tends to give a long term return, uh, irrespective of the near term cycle. See, in this sector normally we'll observe that there is a inventory stocking, destocking, or probably raw material prices has gone up, so it will impact on the gross margins. Those things will keep on happening, but that's where the focus on the core is important, that what are the long-term margins, what are long-term return ratios. Again, here the ROC is very important because this is again a sector where capital cost is high relatively, and that's where whether with that capex one can generate good ROC or not, and the free cash flow profile is also good. So all these things matter in this sector as well, like any other sector.
My last two short questions, and one question would be like a summary for our viewers. 2020 calendar year, what will Shreyash actually look as top three sector picks, where he thinks that these three sectors actually are looking on a good, strong ground?
I would, frankly, the way I would answered earlier, I would stick to that. The anomaly in terms of the valuation gaps among or between sectors would be very difficult in these times. It because it is, so to say, discovered market in that sense, when everyone has looked at all the companies, right from top 50 to top 800, right? And in such a scenario, that individual sectors, and if you just go back and last 1 year, you'll observe that every 3 months there has been sector rotation. So initially it was about auto, then everyone said that no, now the financial will not do well. It started performing after 3 4 months. It stopped. So that kind of thing. So it gives you illusion that it's a sectoral market, but actually, if you take full year view, then probably it's the individual stocks which has done well in some sectors. So last year, again, if you take a last calendar year, at the headline level, financial services would have done good. But then if you look at whether all the stocks did well, probably the answer is no. And though these are, that's why I'm just saying that it's very tricky, because there is a value element to it. There is a growth element to it. There is a B2C element, B2C versus B2B element to it. So there are multiple elements which are playing, and that's where the sectoral call becomes very tricky in such a scenario.
Right. My last question. You have blue chip funds also, mid-cap funds also, so you have sort of your finger on the pulse of entire basket here. Um, Between large caps and mid caps, very popular question we ask every time in a particular point of the year. Large cap versus mid caps, where are we positioned right now? Which one actually is more richly valued? For our viewers, if they really want to sort of pick between large cap and mid caps, what will be a sort of preferential choice at this point of time?
Okay, very, you can say, so to say, not a clear answer to it, but I'll just give you a perspective around it, which in my opinion is important. One is, there is one way to look at large versus mid is from the risk reward point of view, that risk is more in mid and low in large, and so on and so forth. So that is a one perspective which everyone keep in mind. And because one should not go by last 2 3 years return and say that yes, now this is the segment which will do well. So probably in the post-COVID rally, mid small did extremely well, because of which 3 5 year returns look very good for them. While if you go back to 2020 beginning, then the large cap would have beaten down mid and small hands down over 5 10 years as well. Now in this market, post-COVID market, certain things have changed, and that has a repercussion on these large versus mid choices, apart from the traditional risk reward frameworks. What has changed is there is a definitely what happened was pre COVID. the valuations of B2B was lower and the valuation of B2C were higher. What COVID did is the growth in the B2C came down while the growth in B2B has not got affected to that extent. In some cases, it increased. And this valuation gap, which was there, it got breached. So now even B2C is expensive, B2B is also expensive. In some cases, B2B is more expensive than B2C. When I say B2C, it's a consumer-oriented company, and B2B, I said everything like chemical, industrials, and IT and auto ancillaries types of companies. Now, because this gap has breached, what repercussion it has on mid and small, I'll come to that point now, is if you take your large cap indices or large cap funds, then large cap indices and large cap funds are more oriented towards by weight towards the financial services, which is more to do with retail credit growth,
Yes.
FMCG, auto, and mostly it is a consumption oriented segment, the large cap segment is. And that's where it underperformed in this post-COVID recovery time because the consumption-oriented set companies didn't do well on ground and as well as their valuations were high. On the other hand, mid-cap and small-cap segment is more oriented towards B2B. So chemical, mid-cap IT, auto ancillary, etc. And now these companies, if you notice that they have done well during this post-COVID, that's where the mid and small cap as a segment has done well. Now, when it comes to taking a call from here on, this call would be very important to take that now whether the consumption comes back or it would languish the way it has been or and B2B continues because this would be a very critical one when it comes to the large versus mid cap choice. And and one aspect you brought in was the valuation. You will observe that the consumption oriented companies, especially the financial services, maybe FMCG, they have not got re-rated much from pre-COVID to post-COVID level. So from a point to point, they have not got re-rated much, while the B2B oriented companies, the ones like industrials, chemicals, ITs, and auto ancillaries have got re-rated from the pre-COVID to the current level because of these reasons. So that valuation gap has breached in these choices between the consumption oriented versus the manufacturing or B2B. The call on which segment will continue to do well would be critical. So if you're diversifying in your portfolios, one should have this element in your mind. Apart from the risk reward, which we have traditionally in our mind that mid cap is risky, large cap is less risky, and all that prevails. But this is the aspect one need to keep in their mind while diversifying or while choosing large versus mid for their portfolios.
Okay, with that food of thought, we actually come to the end of the show. Shreyash, thanks a lot for sharing all the insights on the markets and the sectors and how actually you choose your preferences within the market here.
Sure, thank you very much.
And with that, viewers, it's a wrap on this show. Thank you for watching us.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.